All right, ladies and gentlemen, thanks for your time. I appreciate you listening here. I'm here to talk about a fund that I'm managing, and we have been investing in one private equity position that we had to come up with a creative accounting solution for this profit that realized on this private equity position. And so I'd like to share this with you, a little bit about my background. So I got my education at the University of Chicago Booth School of Business, PhD in Finance and Economics. I've been working, I used to work for 3 years at UBS for the board of directors, and MBA from Tel Aviv University, and a bachelor from Tel Aviv University. And our fund invests primarily in loans, okay, personal loans of various types, and real estate-backed loans, and invoice financing deals. And the nature of the fund is, because all of my capital is invested, I live off the capital, is that this is not a gimmick or a niche fund, because we can't just have that be. Then it needs to be quite well diversified. And so we're diversified over about 100,000 single borrowers all over the world, and about 1,000 real estate-backed loans. We're financing the construction of about 1,000 properties, and a few hundred invoice financing deals. And yeah, we're tax compliant, tax efficient. We report directly to the Swiss tax authorities as regards the taxable income for our Swiss shareholders. And also we are CRS compliant, so we report to whichever local tax authorities, if they come from the UK, Germany, Israel, Brazil, and so on. Now, the objective is to obtain about a 10 or 15% net return in a good or regular year, and control the risk such that in a stress scenario, it's no worse than -10 or -15%. Okay? And some of these assets that we purchase are they're private loans, and I'd say that they are under-recognized, under-capitalized, and so they provide what can only be assessed as excessive returns, given that they are so diversified over so many borrowers, yes, of low quality, yes, there's high default rate, especially for the unsecured loans, but after defaults, after collection attempts, we're still making our 11, 12, 13% net returns, and then that's where we like to invest. And then a little bit about the philosophy. We're passive investors in the sense that we don't pick single stocks, we don't time the equities market, but we're active in the sense that our allocation to these private loans originated by local loan brokers is high relative to their prevalence in the investable universe. So this is a bit how the portfolio looks like. About a quarter, a bit more, of our portfolio is in personal loans. Up to half of our equity is in real estate financing, either by loan or by equity investment. All of it is short-term financing, between 6 and 18 months. We like the money to turn faster, and so we get a higher yield. But these, of course, are properties in construction. They're not yet stabilized, so the risk is higher. When comes recession, these will produce losses, I guess, more so than stabilized assets. And we've made one private equity investment, just one, and it's been a huge success. It is actually was so successful that it represented an accounting problem for us. And I'll get to that in a second.
Excuse me.
Yeah.
You had stress losses, for some positive stress losses and some zero. Could you explain that?
let me skip that because it's not really critical. I'll take that question afterwards. Okay? It's not that critical. So this is like how our portfolio of, say, personal loans looks like. So each line is a personal loan originated in Estonia, one here is in Finland, and you see it's a very high interest rate, but also a very high and predictable default rate. We're netting about 12% after defaults, after collection attempts. So this is diversified over 27,000 individual borrowers. And this is another asset class, real estate-backed loans. We take only the first lien, we never take the mezzanine, because we can make our 10, 11, 12, 13% in a first lien mortgage for property in construction, either the bridge part or the construction part, and 70% loan to value. We go by trusted, regulated loan brokers that do the due diligence, do the legal work, do the collection, administration if necessary. And this is kind of how it looks like. And similarly, these are part of our portfolio of invoice financing deals. So a small company would provide a product or a service to a larger company with terms of payment of 30, 60, 90, 180 days. We would step in, provide financing for the smaller company, which is usually choked from credit, and diversify, and we go by a trusted loan broker, does the due diligence, has a proven track record, is regulated locally. And then that's our bread and butter. And this is the one private equity investment which we've made. We dabbled in Bitcoin, okay? We had Bitcoin, we sold our Bitcoins. As part of that, we were exposed to this exchange, Bitcoin exchange, which had the largest market share, still does have the largest market share for the Bitcoin dollar trading pair, called Bitfinex. And they were in stress because they lost a lot of the clients' Bitcoins. Very unpleasant. $72 million worth of clients' Bitcoins, poof, gone. And so they were distressed, and then they offered us to convert what they owed us, we all had to take a haircut because of this, into equity in this firm. And the valuation at the time was kind of a 0-1. If they're gonna survive, and maybe Bitcoin's gonna recover, Bitcoin was under $1,000 per coin at the time, then it's a good deal. And if they're pushed into bankruptcy, then it's a bad deal. But it turned out to be a very good deal. And this is our performance. You can see in 2017, we were riding some of the Bitcoin. And I want you to see this last part, because about a year into buying these shares, it was already obvious that it's going to be a huge success, this private equity investment, because it was paying big dividends. We bought it under $1 per share. It was paying already $5, $6 per share just in cash dividend. So obviously the price is no longer $1 per share. And so, but in our books, we couldn't yet revalue it to anything. And so we knew it was a success. We knew it's going to get revalued and produce an accounting gain. And so we didn't want to let any new shareholders into our open-ended fund. Because say, think of an investor coming in just a month before we revalue, is going to be up plus 10% or plus 15%, but that's not fair. He shouldn't be participating. That was the challenge. For a while, I kept the fund closed. But then I found out the accounting solution. So to get to the accounting solution, I need to tell you how I do the share series accounting. So you know, if you're in the hedge fund world, private equity world, that the high watermark concept introduces an accounting issue that the prices of each series will differ. It has memory. So let's say first investor starts at 100, then we go down to 90. The second investor comes in, yes, I can issue at 90, but then if we go back to 100, the new investor needs to pay performance fee, but the old investor doesn't need to pay. So their share series price will deviate. And so the most basic technique to take care of this is to keep each series separate with its own price and its own valor number. And we didn't know at the time when we chose it that this will allow us also the solution to our allocation of this profit from this private equity position. But I want you to keep in mind that every series, even if it's the same investor, but investing in different times, he gets his own series. I want you to keep that in mind because that's what enables us this solution for the allocation of the profit from the private equity revaluation. So yeah, about the accounting of each of our positions, what is public securities is mark to market. The loans are valued as per a kind of a reasonable accounting methodology, and the private equity, as is standard, we keep at historical cost until we reported about a valid transaction that took place, either privately or if it goes public. And yeah, a little bit about open-ended versus closed-ended. You all know that private equity funds are closed-ended funds, almost always. People pool money together, that money is allocated to investments, and after 5 or 7 years, it gets liquidated and the money gets distributed. And no investor is allowed in or out in the interim. And the reason is exactly what was my problem. That you cannot revalue the positions in the meantime. Either you're diluting existing shareholders, or you're unfairly enriching them. And so this is where the name of the lecture comes. What can private equity learn from hedge funds? I'm going to get now to how we exactly solve this. So here, we were reported a transaction in the shares at $20 per share, but anyways, we revalued it to be conservative only to $10 per share. Still be conservative. But this resulted in this bump. And you can imagine that we in fact had a subscription the 1st of June, and on the 30th of June, we realized this profit. It would be extremely unfair to existing shareholders if the new subscriber would participate in this profit, especially since I'm the biggest shareholder. The solution is what I call timestamping. What I do is firstly, any regular profit or loss, say from mark-to-market gain in securities or interest payment coming in, is allocated at the time it's realized based on the shareholding key at that time, which goes by the dollar value of the shares, not the number of shares. But what we do with this one position is that we said, up to here, now we know it's a huge success. We're going to timestamp the shareholding key at this point in time when we close the fund to new shareholders, do this very reason, and let it go. And then when we revalue those shares to a valid market price, that profit will not be allocated based on the shareholding key at that time when new shareholders have subscribed since. It's going to be allocated based on a historical shareholding key at the time of the timestamp. Is that understood? So this basically excludes new shareholders from participating in the realization of this big profit and allocates that profit only to those shareholders on record at the time of the timestamp based on their dollar value shareholding at that time. And actually, we can take it even one step further and say, well, that timestamp that unique timestamp, maybe we want to be more flexible and say, let's allocate the profit all the way from the time we purchase the shares and equally each month, at the end of each month until the time we close the fund. And that's actually how we did it. So we timestamped it equally at the end of each month from the time you purchased it and until the time you close the fund to new shareholders, do this very reason. And then this is equivalent to allocating the profit ex post equally along this period without having to restate our past performance. And this way we can keep the fund open-ended without unfairly diluting existing shareholders. And this is how it looks like. So on the 29th of June, just the day before we revalue the shares from $3.50 to $10, we took a print screen of the dollar value shareholding in our fund for each series. Okay, some of these series are the same shareholders which subscribe at different periods of time, but they still get a different series. This is their dollar value shareholding in the entire fund. And this is their shareholding ownership in just that one account, which was time-stamped equally from the time we purchased the shares until the time we closed the fund to new shareholders, do this very reason. And you see that the shareholding is much tilted towards the earlier series because they were there for a longer period of time, and at a certain point, after we closed it, you see new shareholders came in, so they participate in everyday interest accrual and mark-to-market P&L, but they do not participate, they're excluded from the P&L that realizes on this one position only. And this is what we came up with, and I hope that you find this useful. I'm trying to kind of present this wherever I go because it's a bit of an innovation in accounting. How can you innovate in accounting? It's a bit of an innovation that I'd like to see more private equity funds keep themselves open and not closed. And that's where potentially this could be put to use in the applicability to private equity funds, that private equity funds can similarly timestamp the various investments that they make, and then when they realize either a profit or a loss, that profit or loss is only allocated to those shareholders at the time of the timestamp or timestamps. And there's various ways of doing it. Let's say you pull some money and you put this into some investments, and if you just do one timestamp, then the next time you raise more money, then you do the next timestamp. That's really equivalent to having separate closed-ended funds. But if you say, well, the uncertainty period with respect to this investment is about 1 year, so ex ante we're gonna say commit to timestamping it equally for the coming 12 months and then stop, and anyone subscribing in the meantime will participate in this pro rata to his shareholding, pro rata to the time that he spent during this timestamping window inside the fund, then that's a very elegant way to let people participate in investments that had already started without unfairly diluting or unfairly enriching existing shareholders.
But it's only if you can deploy the new money proportionately into the old assets.
No, you don't have to. You can still timestamp it even if the new money is going into other investments. The old investments are closed, but you can still timestamp it, and then new money comes in. You continue to timestamp the old investments. The new money goes to other investments, but it still has been timestamped. So.
But isn't that what administrators do anyway?
No, they don't do this.
Do you have a fund administrator for your fund?
Yeah.
Right. And why are they not doing that?
This is just beyond what regular fund administrators can do.
I mean, but why not use then different share classes? Isn't that cleaner?
It's equivalent. It can be equivalent.
Okay.
We can catch up a bit more because I want to dig your brain. Thank you. Any other questions? Thank you very much.
Thank you.